Hi everyone. So because of tomorrow's snowstorm, I thought it'd be a good idea to try to do the next best thing, which would be to make a video of the slides that I would have done. And as I said in my message to you, this is my first time doing this, so the special effects and the choreography and all that is probably not going to be up to your expectations, but hopefully you will find this helpful in advance of next week's review and then the exam. So let's just get started. A lot of these slides are ones that I hoped we might get some of them in yesterday, but I knew we probably wouldn't with Jeff, our guest lecturer, who I hope you found interesting. I know a lot of the stuff that Jeff talked about was probably a little bit out there, but as long as you picked up a few new ideas from him, that's all I was really hoping for, and I thought it was a fun class. Anyway, so let's go ahead. We'll be patching together a few things and wrapping up with bonds and talking just a little bit about what to expect next week. Okay, so let's move on. Okay, first of all, growing perpetuity. We talked again about it last week. It's really more of a stock term than a bond term, but as I think you're starting to see, everything kind of relates to everything else. And we talked about it on Monday. This is one of the formulas that I do want you to know. Cash flow that comes at the end of the first period is in the numerator, and then denominator is the difference between the required rate of return, R, which is also known as the discount rate, has a bunch of other terms that we use, cost of capital, and then G, the growth rate. And the formula only works if the growth rate is less than the required rate of return. If it kind of doesn't really make sense, as we'll start to understand a little later in the class, to have a growth rate that exceeds for any length of time the required rate of return. It might exceed it for a couple of years. We don't really have the time with all the other stuff to really get into this right now, but it's certainly important stuff. Anyway, growing perpetuity, as I've talked about, is very useful for one of the ways of valuing a business, or at least part of the way to value a business, and something that you will encounter if you go on to any kind of corporate finance work. Okay, so here's an example. I played around with the numbers a little bit from what we looked at yesterday. Imagine a company that's supposed to earn $10 million this year, and let's just say that investors that buy stock in companies like this figure, okay, we're expecting that we're going to make at least 10%. If we don't think we can make that much, we won't buy the stock. In other words, we would only buy the stock if the price went down from where it is now. So 10% required rate of return. Now growth rate, we're just going to say, has been 4% and is going to continue to be indefinitely. Okay, it's just an estimate, but we're going to use it for this example, and it's a good starting point. So if 10% is the required return, 4% is the growth rate, and the company is going to earn $10 million, we'll just pretend it all comes at the end of this year, even though it would, in reality, of course, come over the course of the year with any real business. What's this company worth? Okay, just using our formula, 10 million goes in the numerator, that's our cash flow. The difference between the required return and the growth rate is 0.1, 10% minus 4%, or 6%, so 10 million divided by 6% gives us $167 million, and that's the value of the company under these assumptions, okay? Now, let's say, so the company is trading in the market, the value had been $167 million, then one day something changes, some news comes out, whatever, and now the market value has gone down from 167 million to 125 million, all right? What is that saying about the expected growth rate? Do you think it makes sense that investors now think the company is going to grow faster or slower? Hopefully your intuition is that it means the market thinks the growth is going to slow down. Wouldn't make a lot of sense otherwise. So anyway, what we're going to do now is rearrange the formula, because what we want to know is what the new expected growth rate is. And we want to get a sense of what kind of change in growth expectations are required to create that kind of decline in market value. Okay, so we need to solve for G. We start out with our perpetuity formula, PV equals present value of a growing perpetuity. cash flow divided by the discount rate minus the growth rate, C over R minus G, but we're going to rearrange this algebraically to get it to the point where it's in terms of G. Okay, so just a few simple steps in algebra, rearranging this, and what we end up with is the growth rate equals the discount rate minus the ratio of the cash flow to the present value, which here is 10% minus 8% or 2%. So as we expected, the expected growth rate did fall from 4% to 2%. So that's may or may not sound like a lot. It is a lot. It's getting cut in half, so let's just look at this a little bit more. 4% to 2% decline in expected growth caused a 25% loss, okay, in the market value, 42 million on a base of 167 million. So it sounds like a lot, right? And it is a lot. And it's a lot because perpetuities are very long dated, and we know that a change in interest rates, and while this is not exactly an interest rate change, it's closely related to it because we sort of adjust the interest rate that we use, the required rate of return, we adjust that by how much growth we expect in order to use this formula. Okay, so we see that what may not look like a big change in growth, or maybe it does look like it anyway, we get a pretty big change in value. But you might also say the other way, well, wait a minute, Bill, this is a infinite cash flow. Perpetuity means it goes on forever. Now, you told me that duration, because we're kind of thinking about something like duration, you told me that if I had a 30-year zero coupon bond, its duration would be 30. Well, this is beyond 30 years. This goes on forever. So why is the duration, or something like duration, only about 12? I'd say good question. But the reason is, remember that a zero coupon bond doesn't pay anything along the way. A zero coupon bond, you get all the money at the end. Here, with a growing perpetuity, any kind of perpetuity, you're getting money all along, and that helps reduce the duration. It helps reduce the effect of an interest rate change, a growth rate change, whatever, on the value. Okay, so, and in fact, what you'll see when you look at 30-year bonds that pay coupons, you'll usually see that they have duration somewhere in the range of 12 to 15, sometimes a little less, sometimes a little more. So nowhere close to 30, and that's because you're getting these cash flows. It's because of the annuity portion of the bond as opposed to just the part that comes at the end, because a zero coupon bond has no annuity portion, okay? All these concepts you should start to be getting a little bit used to. So let's move forward. Okay, bonds, some key concepts. I think we talked about this, you probably saw this slide or something like it on Monday. Most bonds pay interest twice a year, so get used to, if you have an interest rate, very often you're given an annual interest rate, but you'll have to break it in half. You'll break the coupons in half that the bond pays. You'll double the number of periods, that kind of thing. So we have a bond, typically pays interest twice a year, pays principal at the end. In the U.S. As Jeff said yesterday, often European bonds only pay once a year. We're going to focus on the U.S., that is where we are. Then we get those interest payments, say twice a year. That's like an annuity. We get that principal payment at the end, and we just add those two pieces together. We know, we've gone through again and again, and we'll continue to do so, how you figure out what these are worth. I want to make sure you can do it algebraically, that you really understand it. I want to make sure you can do it with a calculator, because there should be no reason why you don't know this stuff cold. You don't need to be a finance expert to understand these things, and it's really important. Okay, key concepts. Coupon, that's in the contract. We're going to talk about this in just a minute. In the contract that governs the bond, it says what the coupon's going to be, what the cash flows are that the borrowing company has to pay to the investors. Those usually do not change. They do change if it's a floating rate bond, which we're just very, very briefly mentioning. We're going to be focusing on fixed rate bonds where these coupon payments are fixed, okay? So when interest rates change, these coupon payments don't change. What does change is what they're worth, okay? Face value, that's what you get back at maturity. The typical amount in the U.S. is denominated $1,000 denominations. Okay, if you buy $1 million worth of bonds, it means that you're buying $1,000 bond, but you're buying 1,000 of them. That's technically the way it usually works. Maturity, how long it takes until you get your money back. Usually it's repaid at the end. Sometimes there can be some bonds where maturity gets paid back a little bit over time, but what we're looking at, and that's kind of the way annuities themselves work, but no, we're focusing on bonds now that pay principal back at maturity. Really focus on that. Discount and premium bonds we talked about. Discount is when it's trading less than par value, which means that the yield is going to be more than the stated coupon rate, okay, because you're not only getting the coupons, but you're also gaining the difference between what you pay for the bond and the final amount. You're paying less than the final amount. Similarly, premium bonds, if they've gone up in price because interest rates went down most of the time, okay, you're still getting the same coupons, but then you're going to lose that premium amount. If a bond is trading at, say, 102% of par, you're only going to get back 100% of par at the end. You're going to lose those 2 points, and that will cut into your yield a little bit that's generated from your coupons, okay? You've been given a lot of homework problems to do in calculating bond prices and bond yields, so all this should pretty much make sense to you now. You've got to understand the difference between a coupon, which is fixed with most bonds, and yield, which moves around with market conditions, okay? If Charles is able to hold his review session tomorrow, I'm sure he'll spend some time going through this. Make sure you know this. Come prepared with questions next week, okay, if you're not comfortable with this. Okay, and we were working through this bond calculation problem yesterday, so I'll be fairly quick here. 5% coupon on $1,000 face amount tells us that the annual interest payment is $50 on this bond. It's semi-annual, so that's $25 every 6 months. The yield of the bond, we say, we were calling it the interest rate to use, the yield, same thing, 7%. Okay, so we know we should automatically, the bells should be going off in our head. 5% coupon, but yield 7%, this bond has got to be trading at less than face value. Okay, whenever the yield is more than the coupon, the bond is trading at less than face value, because if you want to make 7% and you're only getting 5% from the coupons, you have to get the other 2% some other way, and the only real way to get it is by buying the bond for a lower price than what you're eventually going to get back. All this, again, I want it to really start getting to be in your mindset. So the interest rate that we're going to use, the yield, 7% a year. We're doing our calculations semi-annually, so we divide that by 2 to use 3.5%. We're going to have, it's a 6-year bond, but we're going to get paid twice a year, so that's 12 pay periods. So we know how to figure out our annuity. We just use our standard annuity formula, which is one of the things, again, probably the trickiest thing that you need to learn for the exam, but hopefully you've looked at it so many times that you get it by now. And remember how we got this annuity formula. It's just the difference between two perpetuities. It's a perpetuity is very simple, just C over R. It's the difference between a perpetuity that starts today and a perpetuity that starts out in the future when the annuity itself ends. Remember those lines, those parallel lines that we drew, and showing that the difference between those two parallel lines is the annuity. So here's our formula, and it comes down to the cash flows, just the interest payments, have a present value of 241 and change. Okay, now that's half of our work. The rest of the work, which is really easier, we just figure out the present value of the principal repayment at the end. That's $1,000 at the end. I wrote how due. I guess I should have said now due, but you know what I meant, I hope. 1,000, and then we discount that back. We're doing it semi-annually, so it's 3.5%. Over 12 periods, and that $1,000 that we get at the end of 6 years with semi-annual discounting, that's $661.78. We add that to the annuity portion, and we get a little over 90%, a little over 903 out of 1,000. We worked through this yesterday, and again, this is about a little less than a 10% decline. 6-year bond, you should be thinking in terms of, as we've said, a 6-year bond. If it was a 0 coupon, that would mean duration about 6. That would mean a 2 percentage point change in interest rates from 5 to 7 should be about a 12% loss in the bond. We had a loss of about a little more than 9.5%. So it's less than if it was a 0, as it should be, because this bond has been paying coupons. And we'll get to just a little bit more understanding of duration. Again, one of the most important things that you can learn in this class, one of the most important concepts in finance is duration, which is a measure of how bond prices are affected by changes in interest rates. Okay? Now, we've done a number of examples with the calculator. Make sure that you know how to do this. To do well on the exam, you've got to be able to do it algebraically and with the calculator. The algebraic part is the most important. The calculator is really going to be there sometimes to check your algebra, other times to do all the work. You won't have to do algebra on all the problems. Okay? So we put in 12 for n, we put in 3.5 for y, we put in 25 for the payment, the coupon payments. Our future value is 1,000. That's what we get at the end. And so our present value is 903. It's negative because we're laying out the money to buy the bond now, and then all the future cash flows, the coupons and the principal, will be positive. They come into us. The present value goes out. Okay, so I hope everybody is now very comfortable doing this, and I won't say you can do it in your sleep, but do it pretty close to in your sleep. Okay, now I also did this in an Excel spreadsheet. We haven't done that much in Excel. The course doesn't lend itself as much to doing a lot with Excel, but you should. I know all of you know how to use Excel, and if you use the Excel present value function and just put in these numbers, you will get the same result. We will do a little bit more with Excel after the next exam when we get into capital budgeting more. And capital budgeting is where we bring everything together, some of the accounting from the first part of the class, and then the time value of money and bond stuff from the second part of the class. It comes together in the third part, where we'll have the third exam and then the final. Okay? So let's go forward now. The spreadsheet hopefully makes sense. These numbers should look familiar. Okay, we're going to talk just a little bit more about duration that we've been speaking about in the last several classes. And again, this is one of the most important concepts in finance. We're defining it. We're coming up with a simple, not entirely correct definition, but it's more than close enough for what we need right now. The percentage change in a bond price for a 1 percentage point change in interest rates. So if interest rates go up by 1%, say from 3% to 4%, and the bond price falls by 5%, that's saying our duration is 5. If it's a 5-year 0 coupon bond, that's what we would expect. If it's a bond that pays coupons regularly, it would have to be longer than 5 years to have a 5 duration, right? Because the effect of the coupons is to shorten the duration because you're getting some money back along the way before you get your principal back. And again, this is the main idea. I want you to have a rough sense of how to calculate duration. I want you to remember that duration is greater. Duration, once again, is the effect of a change in interest rates on the bond price. Duration is greater, which means the bond price is more sensitive to interest rates, all the things equal, when there's longer time to maturity and when the cash flows come later. Okay, these are two entirely separate issues. You could have a very long dated bond but with very big coupons, and so even though it's long dated, it might not have that big a duration because you're getting back so much money in big coupons early on. Okay, so short maturities and large coupons reduce duration. Shorter maturities and larger coupons, in other words, reduce your exposure to interest rate risk. Okay, let's go on. Now here's, I had a different picture that I found on the internet before. I like this one better. That one had a bunch of numbers and words that you didn't really need to know. This one is more intuitive. So imagine this is a bond that pays these smaller money bags are interest payments, coupon payments, okay, cash flows, and then at the end the big one is getting your principal back. Okay, so now what you need to imagine a seesaw, and imagine where do you put a cone or whatever that will balance the seesaw so that it doesn't tilt from one side or the other. In other words, you want to figure out where to place this cone so that there's an equal amount of weight on both sides, and so the seesaw just holds steady. Now you can see here that we place it after we get the first 3 interest payments. There's no numbers behind this, but it's an illustration that's helpful. Before the 4th interest payment, before the maturity value. Now, if the coupon payments were bigger, if those 4 small bags were bigger relative to the big bag at the end, that would tend to pull our duration to the left. It would make our duration shorter, as you can see. If you just imagine for the sake of argument, it wouldn't make a lot of sense, but if these bags were all the same size and the coupons were as big as the maturity payment, which technically could be possible, then this arrow would have to move to the left. It would have to move to be about 2.5 instead of 3, because you would have 5 equal amounts and you want to be right in the middle. On the other hand, if you took away all these little bags and had all the money coming at the end, clearly right now it would tilt, it would collapse to the right, all the weight would be on the right, so you'd have to move the arrow, the cone, a lot further to the right. Just think about it in terms of where does it balance, and when you start loading up more cash flows on one side or another, that pushes the duration to the side where you're loading up more cash flows. Okay? Once again, think of a standard bond as annuity plus a future value payment. And again, the annuity portion where you're getting the payments along the way. Sorry if I hear buzzing from time to time. Like I said, the special effects of this movie are not going to be that great. So the annuity portion, the regular payments, keeps duration lower. The part at the end, the principal repayment, tends to make it higher. So if you're trying to keep duration low, because first of all, why would you try to keep duration low? Probably because you're worried that interest rates are going to go higher, right? That's the only real reason. If you think interest rates are going to go lower, you want to do the opposite, right? If you think interest rates are going to go lower, then you want your bond portfolio to change as much as possible as interest rates change. You're going to want a long duration. And a lot of times pension funds have had that situation. They want to essentially invest in the expectation of rates going down. But very few people are doing that right now. So if you're worried about what's going to happen when rates go up, you really want to try to keep your duration as short as you can. Of course, there's a cost that comes to that. You typically get paid lower interest rates when you keep your duration very short. Jeff talked about the term structure of interest rates, you may remember, where short-term rates tend to be lower than long-term rates. And so you get the benefit if you keep short-term bonds. You get the benefit of minimizing your exposure to duration risk, to interest rate risk, but you also get paid less. You earn less money for it. So there's a trade-off, okay? But if you're trying to keep duration low, let me just hang up this call. And hello, goodbye. Sort of real-world movie here. Anyway, if you're trying to keep your bond duration low, you're going to keep short maturities, and you're going to keep in bonds that pay fairly large coupons, relatively large coupons. You will avoid longer, really long-dated bonds, and you will avoid zero coupon bonds. Okay? Let's go on. Now, a few more concepts with bonds. We're not going to have a lot of this in the exam, but we might have one or two little things. So bonds are technically the word bond means it's a long-term bond that has collateral. Collateral, Jeff talked about with the idea of his watch being collateral for a loan. Sorry about the typo, it's instruments, not instruments, although I am a Mets fan. The word collateral comes from the Latin word laterus, which means side, and it's basically if you make a loan, on the side attached to that loan is the property that the person who's lending the money gets to hold on to until the borrower pays it back. Okay, so bonds technically have collateral, but in reality, we just use the word bond to cover pretty much anything that borrows money and then pays it back. Call option very quickly means the issuer, the company that borrows the money, it may say it's a 20-year bond, but the company may say, you know what, even though we're borrowing money for 20 years, we want to have the right to pay you back after 5 years. And why would a company want to do that? Why would it want the right to pay back money early? Well, let's say that it borrowed money at 8% and then the company does really well and it becomes perceived as a lot less risky, and it now can borrow money at only 5%. It doesn't want to have to keep on paying that 8% for another 15 years when it should only have to pay 5%. So it can force the investors to sell the bonds back, and then it can replace that with debt that pays a lot less. Put kind of goes the other way. Put option means that the investor, maybe it's a 20-year bond, but the investor says after 5 years, I get to sell it back to you at par, which really transforms it from being a 20-year bond into a 5-year bond. Of course, the investor may decide that they don't want to put the bonds back. Again, if the company's doing really well and bonds paying 8% and a new bond would only pay 5%, the investor probably will not want to put the bond back. Okay? Notes. What is notes? Notes are usually just kind of bonds, except they're not bonds because they mature in less than 10 years, and they usually don't have collateral. Debentures can be pretty much any maturity, usually longer dated, but never have collateral. And then what is funded debt, a term you may encounter once in a while? It basically means longer than a year, as opposed to just a short-term liability. Okay? Few more features just to keep in the back of your mind about bonds. Again, probably won't be big topics for the exam, but you should know. Indenture, you may have heard that word. It's a legal term that specifies everything that's in a bond. Everything from the coupon rate, the maturity, any options like calls and puts, and then things like covenants, which we're going to talk about for just a minute, that govern what the issuer basically can and cannot do. The idea of a covenant, you may recognize the word. It's used a lot in biblical translations. It's the Hebrew word is berit. Those of you who know Hebrew can criticize the way I said that, but the idea is that it's a pact. It's an agreement. Obviously, the parties are different in the Bible. I won't get into that. But in bond terms, it's a pact between the borrower and the lender. And it says what the obligations of both sides, but really the obligations of the borrower are. And a borrower basically has two different kinds of obligations. One is what they call the thou shalt, which means you have to keep a certain minimum amount of working capital so that you're not in danger of not being able to pay your bills, and you have to, on a more ongoing operating level, you may have certain coverage requirements to show that the business is functioning okay. And if you can't maintain those, then the lender can usually step in and say, okay, you're not living up to your commitment. I have a right to ask you to pay me back right now, even though the bond wasn't supposed to be due for another 10 years. Okay. Now, the shalt not type examples basically say, okay, you can't pledge collateral to somebody else. That's my collateral. Or even if I didn't have that collateral, you can't go just give it to somebody else because that weakens me if I've already loaned you money. And you can't pay dividends unless I say it's okay having loaned you money. You can't borrow more money that gets paid before I get paid unless I say it's okay. Now, I might decide I have to say it's okay because it actually, if you're really struggling, and I know you can't pay me right now, but if you go out and borrow more money, even if it's senior to me, at least you have a fighting chance to pay me back. I may agree to that. But right now, I have to have the right to say whether you can do it or not. So this is what covenants talk about. Right? Ratings. We did talk about ratings when Jeff was in class the other day. Ratings agencies, unfortunately, they're very important. I am not a big fan of them, but they have a very big role in the bond markets. The biggest ones are Moody's and S&P, Standard & Poor's, and that's the same S&P that gave us the S&P 500 stock index, okay? Basically, these agencies supposedly provide neutral opinions of how likely it is that issuers will pay back their bonds, and investors use these ratings sort of to do their homework for them. I don't really think that's a good idea, but a lot of investors say, well, I can only buy AAA rated bonds, I can only buy single A rated bonds, I can only buy investment grade bonds, investment grade being triple B and higher, and I'm not allowed to buy junk bonds, which is less than investment grade, or I can only buy 20% of my portfolio in junk bonds, and so on. So rating agencies have a phenomenal amount of power. It's important, if you know anything about the bond market, to know where they stand. Now, some people don't care. Some people don't care, but a lot of people do, and a lot of like pension funds will say we're only allowed to buy investment grade bonds. A lot of that is because if something goes wrong with a bond, the pension fund manager can say, don't blame me, blame the rating agency, and that's what's really going on. Okay, so with that, let's go forward. Just talked about this. Some investors can only buy bonds that have ratings. Some investors can only buy bonds that have high ratings. Some are only allowed certain percentages. There can be very interesting trading and portfolio management opportunities. If there's a bond that's, say, a triple B bond, which means that it's still considered investment grade, and a lot of portfolios own it, and then one day the rating agency comes out and says, we don't like what's going on at this company, we don't think it's as strong as it used to be, we're now going to say it's not as good a rating, we're going to knock it down from triple B to double B. There are going to be a lot of funds that, no matter what they may think personally, they have no choice but to sell it. They're required to sell it, and they're required to sell it right away. So you'll get this avalanche of sell orders in the bond. Probably will drive it in the short term to a price much less than what it's really worth, because it's probably still not that much different than it was before. If it was likely to pay, if it was in pretty good shape to pay back yesterday, unless there's been a really, really big change, it probably hasn't changed that much. So smart investors will look for these opportunities to come in and buy at depressed prices when the prices are sort of artificially low, because there's what we call forced selling. Every now and then that forced selling turns out to be smart selling, but not most of the time. Okay, let's go on. Now, as I've said, we're really going to focus on standard plain vanilla bonds that pay interest in the States usually twice a year and principal at the end. Okay, there are a bunch of other kinds of bonds, though, just you should know a little bit about them. I don't think we'll cover these on the exams, but you never know, and you should know a little bit about this anyway. The most you would have to know for the exam is that bonds like this do in fact exist. I'm not going to ask you any of the math on them. Floating rate bonds, people buy these if they're worried that interest rates are going to go up. They're usually, the interest rate is linked to some kind of index that changes as the market changes. LIBOR, the London Interbank Offered Rate, you may have heard of this. That's one of those measures that's often used for floating rate bonds. LIBOR changes as the market changes, and floating rate bonds are often indexed to a LIBOR rate. Okay, so investors might buy it because investors want to have money invested to generate income, but don't want to lose money if rates go up. You won't lose money if rates go up with a floating rate note, or if you lose money, you'll lose a lot less. You won't make money if rates go down either. A company might issue one sort of on the other side. If a company thinks that rates are going to go down, it's going to want to save money in the future. It may be able to save money right now. In the short term, it can probably get a lower interest rate by doing a floating rate note. Maybe, maybe not. But if it feels, for whatever reason, that it can do better with a floating rate note, then maybe it will. Convertible bonds, that's my thing, where the bond can be turned into stock at the option of the holder usually. If the stock does well, the bond can end up being worth a lot more as a stock than it ever could have been as a bond. So it's still a bond at heart. If the stock doesn't do well, it's going to act like a bond, but if the stock does do well, it'll end up acting more like a stock. Catastrophe bonds are mentioned in your text. I happen to have a very close friend who is an incredibly successful guy, an absolutely brilliant guy, smartest person I've ever known, and he is probably the #1 guy in catastrophe bonds. And what these are, they're very interesting. They're kind of like insurance policies in the form of bonds. And so if an insurance company sells a lot of hurricane insurance and is worried, you know what, if we get hit by a big hurricane, we won't be able to pay everybody back, one thing they can do is issue something called a catastrophe bond. And the investors in that bond, they'll have to pay the investors fairly high interest as long as there's no hurricane, although the interest isn't even that high anymore. It used to be a lot higher because there's been so much demand for these bonds. If there is a hurricane, investors who bought these catastrophe bonds may end up losing everything. That's the way these work. They're very different from most kinds of bonds. So on the one hand, they're very risky because you can lose everything if there's a hurricane if you invest in them. And that's sort of a way the insurance company offloads its risk. It says, okay, well, you know, we took in this money by selling these bonds, and we now don't have to pay it back because there was the hurricane. So even though we're going to lose money on our policies, we made money here, so we kind of hedged ourselves. That's the way the insurance companies might look at it. Why would an investor buy that? You might be asking yourself, why take that risk? Well, for one thing, the interest rates used to be a lot higher. They're not so great anymore. But the reason that investors find catastrophe bonds attractive is because portfolio managers want to avoid having all their eggs in one basket. And stocks and bonds sometimes move together, sometimes don't. A lot of investments tend to go in the same direction. When the market is really selling off, a lot of things go down together. When the market's going up, a lot of things go up together. If you're an investor, what you want to find is something that's known as uncorrelated, where you don't have to worry that it's going to just do the same thing as what your portfolio is already doing. That's a very attractive feature. And the one good thing about catastrophe bonds, the best thing about them, is the weather is kind of uncorrelated to the economy. So the economy may or may not be doing well, but a catastrophe bond's payoff is going to be based on something very different. And that's a very attractive feature. Mortgage-backed, Jeff talked about a bunch of these, about this market the other day. So these can be bonds that you don't know when you're going to get paid back the principal. That you're going to get paid them back based on when people who have mortgages pay off their mortgages. Okay, so that's a different kind of bond. But we're really going to focus on these plain vanilla bonds issued by either governments or corporations, really focusing on corporations in this class that pay periodic interest twice a year in the States and principal at the end. Okay, just a few more to go here. Term structure of interest rates, we talked about this. Jeff talked about this. Flat line, this is kind of what we've assumed in class so far, that there's just one interest rate. And what we call that is a flat yield curve, where it doesn't matter whether it's 1 month, 1 year, 5 years, 25 years, everything has the same interest rate apply. Sometimes the yield curve can be fairly flat, where interest rates don't change much no matter how long it takes until you get your money. Other times it can be very steep, where the rate makes a big difference. The maturity makes a big difference. Okay. Now here's a way that you can generate a yield curve. This is an example. If you borrow money for 1 year, you pay 2%. Usually it's be if you're a government. But let's say the market in its collective wisdom thinks that interest rates are about to go a lot higher because we're worried about inflation. We think the economy is doing well. People are going to want to borrow more money. The cost of money, which is what an interest rate is going to go up because so many people want it. Okay, so if interest rates for a 1 year period, which are now 2% for 1 year, if you think that a year from now, if you want to borrow money for the next year, it's going to cost you 4%, then the question is, okay, what if you want to borrow money for 2 years right now? We know it's got to be more than 2%, you know, because it's going to go up to 4% in a year. We know it's got to be less than 4% because it's only 2% right now. This is how we do the calculation to figure that a 2-year rate would be 3%, which kind of makes sense, right? It's the average of 2 and 4, and it basically works out. The math, because you do the multiplying, you get this cross product term that we've talked about before. It's actually very, very slightly below 3%, but we can just call it 3%. Okay, so that's how a yield curve gets generated. It's based on where the market is now and what people think the market will be in the future. Okay, again, this is Not really this is something that's very important. And if we had more time to go over all this, I would definitely have stuff about this on the exam. We just kind of ran out of time here, but I do want you at least to be aware of this. Right, and here's another graph. Before we looked at a flat yield curve. Here is a upward sloping yield curve where interest rates go higher as the maturity goes on. In this curve, they go higher at a faster rate, then they go higher, they keep going higher as you get more and more time to maturity, but at a slower rate. This is a pretty typical curve. This may remind you of what the curve that Jeff showed you. This is a very common look for a yield curve. Where you have to pay more if you want to borrow money long term, because people who lend money are taking more risk of things that can happen the longer time they don't have their money. They're taking risks that rates can go up, they're taking risks that the world can change, they're taking a lot of uncertainty, and it's important to remember that a lot of things can go wrong for them, not that much can go right for them. All that can go right is they collect their interest and they get their money back. So when it's short term, they're pretty confident of what's going to happen. As time goes on, they're a little less confident, so they're going to usually demand higher interest rates. Not all the time. Sometimes if they think that the economy is about to really slow down, what that means is that in a slower economy, people are less interested in borrowing money to start businesses, right? So if you think there's going to be less demand to borrow money, interest rates will go down. That means that we may get what's called a downward sloping curve, because people think the opposite of the example we just had, where rates go from 2% to 4%. If people think the economy is going to slow down, maybe they go from 4% to 2%. And so if we just reverse the math, then we would have 4% rate for 1 year and 3% rate for 2 years, okay? That's much less common than what we're looking at here. But it does happen, and as I say, it's usually a sign that the market expects that we're going to go into a recession. Maybe it turns out we do, maybe it turns out we don't. Okay, so let's wrap up here. Just talk for a minute about how I want you to prepare for the review session. The thing to do now is both do the homework on bonds and stocks, the new problem set, question set, I prefer to call it, because there's no problems, only solutions. Okay, but I do want you to come to class on Monday with questions. Hopefully, if Charles is able to hold his review session tomorrow, Wednesday, you can have questions there too. These are the things that you need to know. You need to know, you basically laid out pretty much all the formulas I think that you need here. There's not a lot of formulas. What you do need to know, though, beyond the formulas, you really need to understand them. You know how to apply them. You need to know how to apply them. And you need to know how to use them in word problems. And we will work through some word problems on Monday to get you more comfortable with how we do this. I hope you're already reasonably comfortable with this. You also need to know how to plug in the right numbers into your calculator. So I want to see, in order for you to do well in the exam, you're going to have to show that you understand sort of the logic, which you can show through the algebraic solutions, but also that you can use the calculator. It's all necessary, and so you know what to look for. You know what to prepare for. If you have any questions, you know where to reach me. You know where to reach Charles. So good luck with everything. Good luck with the snowstorm. I'll look forward to seeing you Monday, where we'll get ready for the exam. Okay. Good luck. Take care. See you soon.